Stop. Before you scroll. Before you refresh the chart. Before you look at the price of silver on your phone one more time. Because I need to tell you something uncomfortable. What you are looking at is not the price of silver. It feels real. It looks precise. 2 decimals. Green and red candles. A number that updates every second. It gives you the feeling of certainty. But certainty is exactly what breaks first in a crisis. That number was not made for people who need silver. It was made for people who trade silver. And those are not the same thing. The factory manager does not care about your chart. The engineer does not care about your app. The procurement officer does not care what New York says. They care about one thing. Can I get the metal? Today, in my hands. Right now, there are people on the other side of the world who are not asking what silver costs. They are asking how much they must pay to make sure production does not stop. And that number is not coming from America. So if you are still staring at your phone thinking you see the truth, I understand. We were trained to trust it. We grew up believing prices live on screens. But tonight, the real price of silver is not glowing in your hand. It is moving quietly, physically, across borders. And once you understand that, you will never look at that number the same way again. Let me ask you a simple question. When you see the price of silver on your screen, who do you think that price is meant for? Is it for you? A retail investor sitting at home, scrolling between news headlines and charts? Or is it for the people who actually need silver to exist? Because those two worlds do not overlap the way most people think. The price you see is a paper price. It belongs to traders, funds, hedgers, algorithms. People who buy and sell contracts, not metal. They can click in and out. They can change their mind. They can close a position and walk away. But an industrial buyer cannot do that. A factory cannot hedge away a missing shipment. A production line cannot roll over a contract. If the silver does not arrive, everything stops. And here's the part no one tells you. When a multinational manufacturer buys silver, they are not asking, what is the price? They are asking, will you deliver? If the answer is uncertain, the price on your screen becomes irrelevant. That is the gap you are not shown. The gap between owning a promise and holding a material. You were taught to believe price discovery happens on screens. But real price discovery happens when someone says, I need this metal now, and I cannot wait. And once you see that difference, it becomes hard to ignore the feeling that the number you trusted was never meant for you at all. While most of the Western world sleeps, China is awake. Not watching charts, not debating opinions, working. Factories do not pause for holidays. Solar lines do not shut down for sentiment. Batteries do not care about New York time zones. In China, silver is not a trade. It is a dependency. When silver changes hands there, it does not move from one portfolio to another. It moves from a vault into a factory, from a bar into a circuit, from inventory into consumption. This is why the price is different. On paper, you might see one number, but on the ground, the real price is built layer by layer. Exchange price, value-added tax, delivery costs, and the most important premium of all, certainty. Certainty that the metal will arrive, certainty that production will not stop, certainty that a billion-dollar facility will not go dark because of a missing shipment. That certainty costs money. So when you hear that silver in China is trading near $80, understand what that really means. It is not speculation. It is insurance. A solar manufacturer does not ask if silver is expensive. They ask what happens if they do not have it. A battery producer does not wait for a better entry. They secure supply or they lose market share. This is a different culture of thinking. Long-term, strategic, survival-oriented. And while Western markets debate whether silver is overbought, China is quietly doing something far more powerful. It is removing metal from circulation. Once silver enters that system, it rarely comes back. It is used, consumed, locked into infrastructure that will last decades. This is why the premium exists. Not because China is reckless, but because China understands something many investors do not. You cannot negotiate with physics, you cannot replace silver with optimism, and you cannot run a modern economy on promises. So the metal flows east, not loudly, not dramatically, but relentlessly, and the world price follows, whether the screens are ready for it or not. In a healthy market, prices do not drift far apart. That is the whole point of arbitrage. When something is cheaper in one place and more expensive in another, traders step in. They buy low, they sell high, and by doing that, they pull prices back into balance. This invisible mechanism is supposed to keep the global system honest, but it only works when the system is liquid, when metal can move freely, when trust still exists. A 5-cent difference is normal, a small inefficiency, a momentary opportunity. A $5 difference is something else entirely. That is not an opportunity. That is a warning. It tells you the machinery is no longer responding. The gears are turning, but nothing is connecting. On paper, the trade looks obvious. Buy silver where it is cheap, sell it where it is expensive. But in the real world, metal is heavy. It needs permits. It needs time. It needs cooperation from systems that are suddenly very cautious. So what happens instead is simpler and more dangerous. Metal flows in one direction only, toward the place that values certainty more than price. Every bar that leaves a Western vault tightens supply a little more. Every shipment east makes replacement harder. Every delay increases fear, and fear changes behavior. Dealers hesitate. Holders wait. Producers slow sales. No one wants to be the last person holding a promise when everyone else is holding metal. This is how a market breaks without crashing. Quietly, structurally, from the inside. The price difference is not the problem. It is the symptom. The real issue is that the force meant to close the gap no longer has the strength to do so. When arbitrage stops working, price stops being a reflection. It becomes a lagging indicator. And by the time the screen catches up, the metal is already gone. Something strange happens when metal starts moving in only one direction. You do not see chaos, you feel tension. It shows up in small human decisions. A dealer refreshes their inventory page and chooses not to restock, not because demand is weak, but because replacement feels uncertain. A wholesaler answers emails slower than usual, not because they are disorganized, but because they do not want to promise delivery they may not be able to keep. This is what a freeze looks like. Not empty shelves overnight, just hesitation. People who already hold silver are not eager to sell. They look at the price, then they look at the world, and something does not add up. If this metal leaves my hands today, can I get it back tomorrow? That question changes everything. Supply does not vanish all at once. It tightens, it pulls inward. Each decision to wait feels rational. Each delay feels responsible. But together, they create pressure. It is like being in a room where the windows are slowly closing. There is no alarm, no announcement. You only notice because the air feels thinner. This is why premiums rise, not from greed, but from self-preservation. This is why availability disappears before prices explode. The market is not shouting yet. It is holding its breath. And when enough people hold their breath at the same time, movement becomes urgent. Not because everyone wants more, but because no one wants to be late. That is how anxiety enters a market. Quietly, rationally. And by the time most people feel it, the metal is already harder to find. There is a week every year when Wall Street changes its personality. Not slowly, instantly. It happens between Christmas and New Year. Traders leave their desks. Senior risk managers shut their laptops. Decision makers board planes and disappear. What remains is not a market run by people. It is a market run by systems. This is what traders call Ghost Week. Liquidity thins out like a river in a drought. Orders that would normally be absorbed without a sound suddenly echo. In a normal week, a large buy order barely makes a ripple. There are sellers waiting. There is depth. There is resistance. During Ghost Week, that depth is gone. So when a motivated buyer steps in, the price does not climb. It jumps. Algorithms do not hesitate. They do not ask why. They react to what is in front of them. An empty order book looks like an invitation. This is why the moves feel unnatural. Why candles stretch vertically. Why prices seem to teleport instead of trade. It is not panic. It is absence. The people who usually slow things down are not there to do it. And this is what makes Ghost Week dangerous and powerful at the same time. In a market already short on physical supply, even a small push can create a large reaction. Not because something new has happened, but because no one is left to stop what was already building. When humans step away, momentum speaks louder. And right now, momentum is talking. Most people think price levels are just numbers, lines on a chart, psychological markers. But some numbers are not prices at all. They are triggers. 75 is one of them. Behind that level sits a massive structure most people never see. Options, hedges, protection written by banks who believe the market would stay calm. As price approaches that level, something mechanical begins to happen. The institutions that sold those options are no longer neutral. They become exposed. They become reactive. To protect themselves, they must buy futures, not because they want to, because they have to. And here is where it turns dangerous. The higher the price goes, the more they must buy. And the more they buy, the higher the price goes. This is not emotion. This is math. It is a feedback loop that feeds on itself. In a deep market, human sellers step in and slow it down. They take profits. They absorb pressure. But during Ghost Week, those humans are gone. So the buying hits a thin market. The thin market moves fast. And the movement forces more buying. This is how squeezes are born. Not from excitement, not from hype, but from systems reacting to systems. To someone watching a chart, it looks like chaos. To someone inside the structure, it feels like losing control of the wheel. 75 is not a ceiling. It is a door. And once it opens, the market does not walk through it. It stumbles forward, faster than most people expect, and faster than anyone can easily stop. There's a difference between wanting silver and needing silver. Investors want it. Industry needs it. A solar factory cannot pause because prices move too fast. An electric vehicle plant cannot wait for a pullback. A battery line does not care if silver feels expensive this week. It either has the metal or it shuts down. That is the part most charts never show. For an industrial buyer, silver is not an asset. It is an input. Like electricity, like water. If the price rises, they do not walk away. They adjust budgets. They cut somewhere else. They pay. Because the cost of missing silver is not higher expenses. It is lost production, lost contracts, lost market share. That kind of demand does not respond to price. It responds to necessity. This is why supply pressure feels so heavy right now. While traders argue about tops and bottoms, factories are locking in deliveries. While analysts debate valuation, procurement teams are signing contracts they cannot afford to delay. Every solar panel installed locks silver away forever. Every battery produced consumes metal that never returns to the market. This is not a cycle that resets easily. It compounds. And once industrial demand takes the lead, price stops being a signal. It becomes a consequence. This is the brutal reality beneath the noise. As long as the world keeps building, electrifying, and scaling, the demand does not blink. It just keeps coming. In moments like this, markets stop feeling abstract. They become personal. A metals dealer looks at their inventory and feels a quiet fear. Not of losing money, but of being unable to replace what they sell. If I let this metal go today, what will it cost me to buy it back tomorrow? That question sits heavy, so prices widen. Availability tightens. Not because of greed, but because survival comes first. On the other side of the supply chain, the fear looks different. A factory manager watches a production schedule and counts days instead of dollars. If a shipment is late, machines go silent. Workers stand still, deadlines collapse. The cost of silver barely registers compared to the cost of stopping a line. These people are not speculators. They are caretakers of systems that cannot afford surprises. They do not chase returns. They chase certainty. And in a market like this, certainty is expensive. This is why tension builds without headlines, why decisions feel heavier, why conversations become shorter. Everyone is acting rationally. Everyone is protecting their position. But when enough people act this way at the same time, the system tightens. Not from panic, from caution. And that is what makes this phase so powerful. It is not driven by emotion. It is driven by responsibility. And responsibility under pressure changes markets faster than excitement ever could. There's a simple divide in markets like this. You can feel it at night. Some people sleep without checking prices. Others wake up and reach for their phone before their feet touch the floor. The difference is not intelligence. It is ownership. When you hold something real, you think in days and months. When you hold paper, you think in minutes. The person holding physical metal is not calm because they are confident. They are calm because nothing needs to be done. The person holding promises feels every movement, every headline, every candle. They are not weak. They are exposed. This is not about being right or wrong. It is about what you rely on to still be there in the morning. Paper depends on systems, on liquidity, on someone else keeping their word. Metal depends on gravity. That is why nights feel different. One group watches the market, the other lets the market work. And in times like this, that difference becomes impossible to ignore. Because sleep is not a luxury. It is a signal. And the market is quietly showing you who has it and who does not. The truth rarely announces itself. It does not trend. It does not demand attention. It moves quietly. While people argue over numbers on a screen, metal changes hands without noise. No headlines, no alerts. A shipment leaves a vault. A contract becomes delivery. A warehouse grows lighter. This is how real change happens. Markets feel loud when emotions run high, but the most important shifts happen in silence. They happen when no one is watching closely, when confidence still feels normal. The screen shows activity, movement, excitement. But the screen is not where reality settles. Reality settles where weight matters, where trucks move, where inventory is counted by hand. This is why the moment feels strange, not dramatic, just different. Nothing looks broken yet. Nothing sounds urgent. And that is exactly why it matters. Because when the truth finally reaches the screen, it arrives all at once, without warning, without permission. Until then, the metal keeps moving, quietly, purposefully. And for those paying attention, that silence says more than any price ever could. Moments like this are easy to misunderstand. A new number appears, and people rush to label it a top. $80 sounds extreme if you believe the old rules still apply. Rules built on excess supply, on endless liquidity, on the idea that metal is always available if the price is right, but those rules were written for a different world. What we are seeing is not a spike, it is a signal that the market is no longer led by speculation, but by necessity, by physical movement, by real demand. When price follows metal instead of the other way around, the game changes. This does not mean the path will be smooth. There will be pullbacks. There will be moments of doubt, but the direction is no longer set by opinion. It is set by constraints, by how much silver exists, by how fast it can be mined, by how urgently it is needed. This is not the end of a story, it is the beginning of a new chapter. And in this chapter, the people who adapt do not need to be loud. They just need to understand the rules as they are now, not as they used to be, because the market does not reward nostalgia. It rewards those who see change early and move with it.